Money functions as the lifeblood of both personal wealth and corporate growth, yet the deeper we venture into the financial world, the more we realize it's not just about earning, saving, or short-term investments. True financial mastery requires an understanding of advanced corporate finance principles, the workings of capital markets, risk management, and strategies that can help firms and individuals create and preserve value over the long haul. Today, we'll delve into what separates the standard textbook approach from the strategies that truly sophisticated investors and corporate leaders employ when making high-stakes decisions. It's not just about crunching numbers, it's about discerning how and why those numbers matter in the grand scheme of business, capital allocation, and sustainable value creation. A pivotal topic at the heart of advanced corporate finance is the concept of capital budgeting. In a nutshell, capital budgeting is the process of deciding which projects or investments a firm should undertake to achieve the highest possible returns at acceptable levels of risk. This is often accomplished by modeling future cash flows and discounting them back to their present value. If you look at a multinational corporation investing in a new product line or an individual considering a real estate purchase, the logic is fundamentally the same. Estimate the magnitude and timing of incoming cash flows, weigh them against outflows, adjust for uncertainty, and determine if the net present value is positive. But in practice, the real challenge lies in accurately projecting revenues, costs, and external market factors, especially when those factors might shift rapidly. One step beyond simple discounted cash flow models is dealing with risk in a more nuanced way. Traditional capital budgeting might use a single discount rate, often the weighted average cost of capital, WACC, to discount future cash flows. But advanced practitioners refine this further by adjusting the discount rate to account for project-specific risks or by using scenario analysis and Monte Carlo simulations. Scenario analysis might include evaluating a project under different market conditions, regulatory environments, or consumer demand levels. If you're dealing with a mining company, for example, you might model separate scenarios for commodity price fluctuations or new environmental regulations. Monte Carlo simulations go further by randomly generating thousands of possible outcomes based on probability distributions for variables like demand growth or cost inflation, thereby providing a range of possible net present values rather than a single figure. This can help executives or investors understand the probability of success and the downside risks more clearly than a simple best guess forecast. Alongside capital budgeting, the firm's capital structure decisions are equally critical. The composition of debt and equity on a company's balance sheet can dramatically affect both risk and potential returns for shareholders. Debt financing is appealing because interest payments are often tax deductible, which lowers the effective cost of capital. However, too much leverage increases the likelihood of financial distress if cash flows falter. On the other side, issuing more equity can dilute existing shareholders, but ensures that the firm isn't overloaded with interest payments during downturns. The optimal capital structure typically balances these concerns, minimizing the weighted average cost of capital while preserving enough financial flexibility to weather market turbulence. The details can get complex because the cost of capital itself depends on how much debt or equity a firm uses, tying these choices into a sort of feedback loop. When we turn to valuation, especially in the realm of mergers, acquisitions, or private equity buyouts, we have to consider far more than just a classic discounted cash flow approach. Sophisticated corporate finance goes deeper with tools such as leveraged buyout, LBO models, real options analysis, and synergy valuations in M&A. An LBO model, for instance, helps a private equity firm see how much debt can be placed on the target company while still maintaining enough cash flow to cover interest and principal payments. The objective is often to maximize returns to equity holders over a certain holding period, typically 3 to 7 years. By the time the private equity firm exits through a sale or public offering, they aim for a multiple of their initial investment. This is why due diligence in LBOs is so rigorous. Small miscalculations in operating costs, revenue projections, or financing terms can jeopardize the entire transaction. Real options analysis, another advanced valuation method, treats certain investment decisions as options to expand, delay, or abandon a project. This technique is highly relevant in industries with substantial uncertainty and volatility, such as oil exploration or tech ventures. If a firm invests in an early-stage resource extraction project, part of that project's value might be the potential to expand drilling sites if oil prices rise. Conversely, if prices drop, the firm might opt to scale back or hold off on new development. Real options analysis attaches value to those strategic flexibilities. Using option pricing theory, borrowed from derivatives markets. While it's more complicated to apply than standard DCF, it captures the nuance that not all investments are now or never propositions. Managers can and do adapt as new information arrives. Finance also plays a central role in managing a firm's day-to-day cash needs, short-term liabilities, and liquidity. This is especially prominent in financial institutions, where capital must be carefully allocated among loans, securities, and reserves to ensure enough liquidity in times of stress. But any company with significant working capital demands also needs an efficient treasury strategy, optimizing inventory, receivables, and payables to maintain adequate cash flow. The 2008 financial crisis highlighted how even large, seemingly stable companies can run into trouble if short-term financing seizes up. Having healthy liquidity buffers and diversified funding sources is crucial, regardless of an organization's size. Turning to the realm of real estate finance, we find an entire ecosystem of valuation metrics and financing structures that differ from corporate finance, but share similar fundamental principles. Real estate investors scrutinize cap rates, the ratio of net operating income to the property's value, internal rates of return, and cash-on-cash returns. Financing deals might involve complex structures such as mezzanine debt, preferred equity, or even structured partnerships that share cash flows in varied ways. Over the years, real estate private equity has become a booming sector, blending the tenets of corporate finance, such as leverage and capital structure, with the peculiarities of property markets, location, zoning, tenant risk, and economic cycles. When interest rates are low, real estate syndicates or funds often exploit cheap debt to acquire properties, target improvements, and sell or refinance once the property's value has appreciated, mirroring a leveraged buyout in many respects. Moving on to entrepreneurial finance, the conversation shifts from large corporations to startups and growth stage companies, yet the underlying logic remains connected to advanced finance principles. Early stage startups don't have established cash flows or assets, so traditional discounted cash flow techniques can be futile. Instead, valuation often relies on comparables, traction metrics, or intangible factors like technology potential and founder experience. Venture capitalists conduct due diligence on market size, product market fit, and competitive advantage, then structure funding rounds with preferred shares, liquidation preferences, and anti-dilution provisions to protect their downside. Despite these complexities, the overarching idea is still about balancing risk and reward, ensuring that each funding round aligns with milestones that increase the company's overall value. Risk management remains a vital theme in every segment of advanced finance. Companies face currency risk if they operate internationally. They face commodity risk if their products or inputs are subject to price swings. They face interest rate risk if they rely on variable rate debt. While derivatives, like futures, forwards, swaps, and options, provide tools to hedge these exposures, implementing them demands a solid grasp of pricing, counterparty risk, and market liquidity. A CFO must decide not only whether to hedge, but also how much, under what terms, and for how long, because hedging itself costs money or could limit upside gains if a currency moves in the firm's favor. It's a delicate calculus. Hedge too much, and you might log in mediocre returns. Hedge too little, and you might expose the firm to volatile earnings. When done well, a hedging program stabilizes cash flows and makes long-term planning more predictable. Another dimension of finance at the corporate level is governance and incentive alignment. Large firms, particularly publicly traded ones, face principal-agent issues where management's interests might not perfectly align with shareholders. Executive compensation structures, stock options, performance shares, bonuses, are designed to align management with the goal of maximizing shareholder value. However, misaligned incentives can encourage short-termism, where executives focus on quarterly earnings rather than investing in projects that generate value over several years. Thus, advanced finance also grapples with the psychology and behavior of those making decisions, not just the mechanical process of discounting cash flows. This is why boards, auditors, and regulators pay attention not only to the numbers, but also to how those numbers are being produced and reported. Closely tied to governance is the question of how firms distribute returns to shareholders, namely through dividends or share buybacks. While dividends provide a regular income stream to shareholders, share buybacks can signal management's belief that the firm's stock is undervalued, reduce the number of outstanding shares, and potentially boost earnings per share. Yet these decisions also hinge on tax policies, shareholder preferences, and alternative investment opportunities. If a firm has profitable expansion opportunities, it might be better off reinvesting earnings rather than returning capital to shareholders. Advanced finance therefore involves analyzing not only how much cash the firm can distribute, but also whether distributing that cash is actually the best way to create long-term value. Capital markets themselves are dynamic ecosystems where companies raise funds through initial public offerings, secondary equity offerings, or bond issuances. A deep understanding of how these markets set prices, allocate capital, and respond to macroeconomic signals is essential for anyone operating at a high level in finance. During expansionary phases, capital tends to be cheaper and more abundant, encouraging more aggressive growth strategies. In contrast, recessions or credit crunches can shut the valve on easy capital, forcing companies to rethink expansion, reduce leverage, or raise equity at unattractive valuations. This cyclical ebb and flow underscores the importance of timing and market sentiment in corporate finance decisions. When analyzing advanced finance topics, it's also valuable to consider how external shocks, economic crises, technological disruptions, or policy changes can abruptly alter the financial landscape. The COVID-19 pandemic, for instance, disrupted supply chains, changed consumer spending habits, and accelerated the adoption of digital technology. Firms that pivoted quickly or had resilient business models fared better financially, while those heavily reliant on in-person transactions or with high debt burdens struggled. This points to a broader principle. In advanced finance, resiliency and agility can be more important than chasing short-term gains. Good risk management and strategic foresight can position a company to survive and even capitalize on unforeseen challenges. Another layer in modern finance is the growing emphasis on environmental, social, and governance (ESG) criteria. Investors, particularly large institutional ones like pension funds or university endowments, are increasingly factoring ESG metrics into their investment decisions. Whether it's carbon footprint, labor practices, or board diversity, these considerations can influence the cost of capital, brand reputation, and long-term sustainability. ESG isn't just a buzzword. It represents a shift in how the market values companies that manage, or fail to manage, broader stakeholder impact. Thus, advanced finance now often intersects with sustainability and social responsibility, prompting firms to integrate non-financial measures into their strategic planning. Within the sphere of academic finance, courses often progress from foundational topics like time value of money, risk and return, and basic capital budgeting to more intricate subjects such as real options, restructuring, and global capital markets. Specialized electives might focus on entrepreneurial finance, analyzing how startups and smaller firms get funded and grow, or on private equity and venture capital, where students learn about buyouts, term sheets, and the nuances of scaling high-potential businesses. Meanwhile, real estate finance courses examine how physical properties, development projects, and real estate private equity deals are structured and evaluated. Each of these domains uses the same core principles of valuation, risk assessment, and corporate governance, but applies them to different asset classes and market environments. For professionals aiming to climb the corporate ladder to CFO-level roles, an in-depth understanding of these topics is non-negotiable. CFOs are expected to craft policies on capital allocation, dividend strategy, and overall financial risk management. They must also have a grasp of mergers and acquisitions, be able to structure deals, communicate with investors, and maintain relationships with banks and capital providers. The CFO's office is also increasingly involved in strategic decision-making well beyond spreadsheets, playing a role in product launches, geographic expansion, and even corporate culture. In short, finance has transformed from a back-office function to a driving force in corporate strategy, bridging operational decisions with the broader goal of value creation. Private equity, in many ways, epitomizes advanced finance. Firms in this sector scout undervalued or underperforming companies, acquire them, and then use a mix of operational improvements and financial engineering to boost value. The emphasis on leverage is deliberate. By borrowing a portion of the purchase price, private equity funds can amplify returns to their limited partners, but this amplifies risk too, so the entire process from due diligence to post-acquisition monitoring has to be meticulously planned. If improvements or revenue growth don't materialize, the acquired firm could struggle under its new debt load. In successful cases, however, private equity investments can yield significant returns, fueling even more acquisitions and expansions. Similarly, venture capital takes a high-risk, high-reward approach, but focuses on early-stage companies with exponential growth potential, particularly in tech, biotech, or other disruptive sectors. Because these companies often lack operating history or collateral, VCs rely heavily on the track record of the founders, the uniqueness of the technology, and the size of the addressable market. Funding rounds are staged, releasing capital in tranches as a startup hits key milestones, which mitigates risk for the VC while keeping the founding team motivated to achieve rapid growth. If successful, a venture-backed startup might go public or get acquired by a larger player, returning a multiple of the VC's original investment. Even more advanced than venture capital and private equity strategies is the domain of real options in capital-intensive industries like natural resources or infrastructure. When an oil company invests in exploration, the outcome is uncertain because oil prices, regulatory approvals, and geological factors can fluctuate dramatically. Real options give that company the right, but not the obligation, to expand, abandon, or delay the project if conditions become unfavorable. This is akin to a stock option, except the underlying asset is a real-world project. Valuing these flexibilities involves complex financial modeling, but it provides a more accurate view of the potential worth of a project that's subject to uncertain future developments. Across these scenarios, corporate governance frameworks ensure that managers act in the best interests of investors or shareholders. Boards of directors, audit committees, and activist shareholders serve as checks and balances against managerial overreach or misalignment of incentives. Transparent financial reporting, adherence to regulatory standards, and ethical business practices also factor into the long-term financial health of a company. In today's climate, a single scandal or compliance failure can lead to severe capital market penalties, not just in share price, but also in a firm's ability to raise funds at favorable rates. Finally, advanced finance is incomplete without acknowledging the macroeconomic context, whether it's central bank policy, inflation trends, or geopolitical tensions. External factors play a huge role in shaping capital flows. In high inflation environments, for instance, companies with pricing power or hard assets like real estate often fare better, while fixed income investors see their real returns eroded. In periods of rising interest rates, highly leveraged companies face mounting borrowing costs, which can compress margins and threaten solvency. Conversely, in an environment of cheap money, acquisitions and expansions flourish, sometimes leading to overvaluations or asset bubbles. Keeping an eye on these macro signals is essential for timing financing decisions, calibrating risk appetite, and positioning portfolios for both growth and protection. In essence, the world of high-level finance weaves together corporate decision-making, investment strategies, risk management, and market psychology. From capital budgeting to capital structuring, from real estate syndications to private equity buyouts, from advanced valuation techniques to daily liquidity management, the overarching theme is resource allocation under conditions of uncertainty. Sophisticated finance professionals don't see these as isolated tasks. They recognize the interconnectedness of capital markets, business strategy, and stakeholder interests. This integrated view is what ultimately separates a merely good financial approach from one that generates sustainable competitive advantages and long-lasting value. As the global economy evolves, shaped by the technological leaps, demographic shifts, and policy reconfigurations, financial techniques will also continue to advance. Mastery of these techniques requires not only analytical rigor, but also strategic thinking, ethical considerations, and continuous learning. Finance is no longer just about balancing ledgers or issuing reports. It's about shaping the direction of industries, guiding entrepreneurial ventures, restructuring failing companies, and investing in transformative ideas. Ultimately, the real power of advanced finance lies in the ability to make informed decisions that align with both short-term viability and long-term prosperity. If we step back from all these details, one question remains. In an environment teeming with complexity, volatility, and rapid innovation, how do you stay ahead? The answer may be simpler than it seems. Keep learning, stay curious, evaluate decisions through multiple lenses, and never forget that behind every spreadsheet, there are real economic opportunities and real risks. Finance is not just numbers on a page or lines on a chart. It's a system of decisions that determine the future course of corporations, markets, and personal wealth. Whether you're a seasoned CFO, an aspiring entrepreneur, or an investor eyeing the next big opportunity, recognizing the breadth and depth of these financial frameworks and applying them judiciously is what will set you apart and pave the way for meaningful, lasting success.